Okay, so straight on with the question then, we've got to evaluate some business risks, and then most of the word evaluate, by the way, doesn't just say state the business risks. So it says state them, explain why they are, and what effect it will have, basically. Identify and also explain 4 risks of material misstatement that we would be considering when planning the audit. So let's get on with the question then. These are briefing notes as well. Just very quickly then, this is a company that produces circuit boards which we then sell to companies who make phones and mobile phones, and it's the first time that we have managed this client, but that's all. So, business overview. Their principal business activity is producing circuit boards. One of the key materials used is copper wiring, all of which is imported. Okay, so I can see business risk there already. Now, it does say use briefing notes. So briefing notes would be headed briefing notes. To audit partner, write that out. From audit manager, write that out. Audit planning. And then as the intro, just basically regurgitate the question, just turn it around. So say that we're going to evaluate the business risks of the company, and we are also going to identify 4 material misstatement risks to be considered in planning. So that's just basically the question turned upside down, the introduction really. So on with the business risks, and the first one was that we import a lot of goods. Whenever you get any importing, then we are going to be subject to exchange rate fluctuations, and that will be a risk that we might not meet our objective of making profits, because we will obviously, any adverse movements will hit the income statement, okay, causing losses. So far, so good. As a cost-cutting measure, in April 2012, a contract with a new overseas supplier was signed, and all of the copper wiring is now supplied under this contract. All of the copper wiring under one contract. I see a business risk. What if that goes wrong? So just one supplier. Okay, that's a business risk, one supplier, because what if the supplier has difficulties? Financial difficulties, operating difficulties. Then we have a risk of not having enough stocks of copper, so we're going to have stock outs and therefore a loss of customer goodwill, as we can't supply them. Can't supply the circuit boards for the mobile phones. Okay, just one thing that's come to me as well actually about the imports. If we're importing things all the time, talking about risk of stockouts, etc., just transportation issues in general. Okay, the risk of stockout increases because it's further to get, isn't it? You know, possible disruptions to travel, so the transporting of it again would lead to customer goodwill loss. Okay, super. Keep going. Purchases are in a foreign currency. The company does not use a forward exchange rate. Okay, so we'd put that in here, wouldn't we? No forward rate. So therefore, any adverse movements definitely will hit the income statement. Will make the income statement quite volatile. You might want to put that in as well, a bit of volatility. They have 2 production facilities. One produces goods for the export, other produces for the domestic market. Half of its goods are exported, but the export market is suffering due to competition from cheaper producers overseas. Okay, and most domestic sales are made under contract with just 20 customers. So we have competition in the export market. So competition in the export market would mean possible price wars, and can we manage that? Are we capable of doing that? Let's go and have a look. Are we capable of doing this? Let's have a look at some figures. So revenue is going down. Operating profit has gone down by 50%. Okay, and it's now just at 500,000. So the margins are being squeezed, aren't they? Can we manage that? Probably not. With poor margins anyway. And I would mention the margins if you can. And he said that most domestic sales are just with 20 customers. So we have reliance on few customers. Okay, so an over-reliance on few customers, that can be a big problem again, couldn't it? So we need to keep them happy. Would that mean keep margins low? Okay, that's all we can say for that at the moment, I think. Recent developments. In early November 12, production was halted for the week at the production facility which supplies the domestic market. A number of customers returned goods. There was faults. So here we go, he's helping us out here with more to say then. These few customers already returning goods. Okay, so how are we going to keep them happy if they're already returning goods? So we have some quality control issues, we have possibility of refunds, but also we could lose them. To the competition. Okay, keep going. On inspection, it was found that the copper used in the circuit boards was corroded, unsuitable for use. It's difficult to spot, can't be identified by eye and relies on electrical testing. So quality control, we already mentioned quality control issues, but I think it's worth a point on its own. Okay, is this ongoing? Why was it not found out before it went out? Again, particularly with the margins, presumably the cost of replacing will hurt us, as well as the lack of future orders. Still going then, work has already started on a new production line which will ensure that we meet new regulatory requirements which prohibits the use of certain chemicals, which comes into force soon. So just stop there, more regulations. And can you see how I'm just doing this? It's just the more we go through the scenario, the more we just pick up all the time. So higher regulations means increased risk of non-compliance. And if we don't comply, that's an increased risk of fines, bad publicity, all these extra costs. We then have just got a new loan out of 30 million with an interest rate of 4%. The main purpose to fund this capital expenditure, and 2.5 million of the loan represents an overdraft which was converted into long-term finance. So again, it could be seen as a business risk, the financing. Got the loan in the year. What would be the effect on gearing? What would be the effect on interest cover? Maybe we can calculate that. We are clearly suffering from poor liquidity already because of the overdraft. Okay, and so therefore, if we do run into cash flow problems, how are we going to get out of these? Okay. Other matters, several of the executive directors and the financial controller left to set up a company, so loss of directors, loss of key employees, etc., etc., etc. Okay, a fairly straightforward question. I'm not going to keep going, you can do that bit yourself. I want to get on to the material misstatements though. So, material misstatements, let's see if we can come up with 4. The risk of material misstatements. So, first one I can think of, definitely, we had foreign exchange, don't we? Foreign exchange, what should happen is you should first of all translate at the spot rate, the rate that we actually pay. That might also be an average rate, okay? And then any gains and losses should go to, when we come to actually pay it, should go to the income statement. But what you should also do is retranslate any foreign monetary items, so in this case would be foreign payables, as we pay our supplier, they would need translating. Any differences should go to income statement, but no retranslation of any foreign non-monetary items. So, e.g. the stock, there would be no translating of that. So you want to make sure that they get the accounting right, but you don't just say, it's not enough just to say the risk it's not accounted for properly. You can say that, excuse me, but what you want to say is a little bit more, because if they do get it wrong, then if there's any losses, then the profits will be again overstated and liabilities understated. So just try and go a bit further. When you talk about material misstatements, well, how would it be misstated? Say how and then be specific. So there's one that I remember. There was the product recall, wasn't there? The faulty goods. So the product recall, the faulty goods. First of all, we want to make sure they've written off the copper faulty wiring. And when we say written off, we mean reduce stock and therefore increase in expense as well. We also need to think of, would there be any possible refunds? So a possible provision for that. If they don't bring in a provision, then again we have, if they don't do it, we've overstated overstated profits and understated liabilities. And of course, the inventory probably will be, because if I remember, it was difficult to see. It's difficult to see by the eye. So if it's difficult to see, then it's quite possible that they've missed some stock, some faulty stock. Then there was the loan. We need to ensure that the loan has been accounted for correctly using amortised cost. Okay, because if we go and have a look here, the finance costs have stayed the same. Well, how can the finance costs stay the same if we've got a new loan? So are they really doing this properly? With interest to the income statement, why no increase? So presuming that they haven't done this, again we would be overstating profits and understating our liabilities yet again. The increased regulations, or no, actually I'll go for the additional capital equipment. With the additional capital equipment, we want to make sure that we've only capitalised directly attributable items. We want to make sure that we've capitalised borrowing costs correctly, because if we haven't, we will be overstating assets, and if we've been putting items that shouldn't have been capitalising, but they should have been going to expense, then we've been understating expenses. Okay, that's how you do it. You'd write them out in full. You go through. Just remember that when you're talking about risk of material misstatements, it's the risk that the accounts are wrong, isn't it? You know, so you can state the accounting rule, then you can apply it to the scenario, explain what could go wrong, and then the effect of it going wrong on the accounts. Be specific. Understating this, overstating that, etc. Okay, hope it helped.